Are U.S. office prices staring down the barrel of a crash? Forbes Magazine shares insights from Bloomberg's latest markets live pulse survey, which indicates that the commercial real estate market is potentially looking at 9 more months of dwindling values. The consensus among the majority is clear. We might be heading for a severe collapse before any rebounds are seen. The survey reached out to 919 people, and about 2/3 of them foresee the U.S. office market recovering only after experiencing a significant crash. Many believe that the U.S. commercial real estate prices will hit rock bottom in the second half of 2024 or even later. This isn't good news, especially when you think about 1.5 trillion of commercial real estate debt, as pointed out by Morgan Stanley, that's maturing before the close of 2025. Refinancing this isn't going to be a walk in the park, especially when 25% of commercial buildings that are going to be refinanced are actually office buildings. Notable index from the Green Street shows that commercial property prices have taken a 16% dive from their March 2022 peak. The Fed's assertive tightening campaign is really shaking up property values, escalating the costs associated with owning property, particularly financing expenses. But here's the catch. Sellers are caught in a dilemma. As Lee Overby from Barclays puts it, nobody wants to sell at a loss. I can't blame them. These properties can withstand with being unsold for extended periods, making holders postpone sales as long as possible. Adding fuel to the fire, regional banks holding about 30% of the office building debt are under strain. The ripple effects of the collapse of Silicon Valley Bank and Signature Bank are evident as smaller banks have seen their deposits reduce, translating to diminished lending capacity. Now, the repercussions of heightened interest rates don't just unfold overnight for U.S. commercial real estate owners. Investors in office space usually have long-term fixed rate financing aligned with long-term leases. It is anticipated that it will be a slow pace reckoning till 2027 for the existing leases to align with reduced revenue expectations, potentially seeing a 10% decrease in revenues compared to today. On the flip side, offices are grappling with tenants retreating or relocating, a trend that is especially prominent in the U.S. The reluctance is returning to offices perhaps stronger here than Europe or Asia. Some of this reluctance can be attributed to the hassle of commuting. Striking 40% of respondents in the MLIV Pulse survey admitted they'd be more willing to head to the office if better public transport options were available. The pandemic era has seen about 20% of respondents moving farther away from their workplaces, and non-surprisingly, only 3% regret that decision. Nearly a third experience longer commutes, either due to relocating or due to its cut in transit services during the pandemic. So with all these issues swirling around, we're left wondering if the office sector can weather the storm without impacting the overall market stability. A crash seems to be inevitable. I actually was in Phoenix, Arizona. I toured 5 different office buildings, all 100,000 square feet and larger. They were all empty. There's millions of square feet available in Phoenix alone, just one of the cities. So I actually experienced it, walking through some of these offices that were gorgeous, and they were trying to sell them well below replacement cost. So there is some significant problems. I've never seen so many empty chairs in these offices. If anybody wants office chairs, I saw about 5,000 beautiful office chairs. Anyways, I'd love to hear your thoughts. Do you think retailers will give a heads up about profits, or they surprise us with a positive outlook this year? Drop your thoughts and comments in the section below. Let us know what you think.